Welcome to the Nifty Noon podcast.
It's good to be back. And I have to say, looking at the source material from this past week, February 9th to the 13th, 2026.
Yeah.
This was one of the strangest weeks I can remember in the market.
It really was. I was going through our daily newsletter updates, and it felt like I was watching two completely different movies at once.
Yeah.
On one screen, you've got the absolute peak of institutional sophistication. We're talking BlackRock, Goldman Sachs, really complex DeFi stuff. And on the other screen, just complete and utter chaos.
That is the perfect way to frame it. It was a week just defined by that collision.
Mm-hmm.
If we had to do a too long didn't read for the whole week, it's basically this. We saw a $40 billion operational screw-up in South Korea that, for a moment, minted accidental billionaires.
Just insane.
And in the same breath, we saw the world's largest asset manager, BlackRock, not just buying Bitcoin, but actually getting its hands dirty in, decentralized governance.
Which is a massive, massive paradigm shift. And then we had Tether laying the groundwork for an AI economy, and Pudgy Penguins, the NFT project, basically launching a credit card.
It's a lot to wrap your head around. So our mission for this deep dive is to walk through these stories chronologically, day by day, using the Nifty Noon updates. We're not just going to recount the news. We need to unpack why these specific events are rewriting the market narrative from pure speculation to something, well, much more structural.
All right, let's dive in. Monday, February 9th, we have to start with the chaos.
Oh, we have to.
We're calling this the $40 billion glitch, and honestly, even for crypto, this is a special kind of mess.
It's a cautionary tale that'll probably end up in textbooks. It all happened at Bithumb, which is one of the major South Korean exchanges. They were planning a pretty standard promotional event. The goal was simple. Give users a small reward, 2,000 Korean won. Which is
what, like $1.36?
Yeah, about that. A nice little thank you for using the platform.
Enough for a cup of coffee, maybe.
Exactly. But due to what we can only assume was just a catastrophic fat finger error in a database script somewhere, they didn't credit users with 2001.
Oh.
They credited them with 2,000 Bitcoin.
2,000 Bitcoin per user? That's not a thank you. That's a winning lottery ticket. That's what, roughly $130 million a person?
Correct. And since this went out to hundreds of users, the exchange accidentally created over $40 billion in phantom value on its internal ledger.
Okay, I want to pause here because this really highlights a key distinction. When you hold assets on a centralized exchange, you aren't actually holding Bitcoin on the blockchain, right? You're just looking at an entry in their private database.
That is the critical point. If this had been an on-chain transaction, Bithumb would have been insolvent instantly. The Bitcoin would be gone forever.
Right.
But because it was just an internal ledger entry, it was essentially phantom money. The problem is the users didn't know that. They saw the balance, and they did what any rational person would do. They tried to sell.
I can't even imagine the panic. You open your app, you see 9 figures, you are mashing that sell button.
And that selling pressure was real enough to break the local market. It actually decoupled Bithumb's Bitcoin price by almost 16% from the global average.
A flash crash.
A flash crash driven by money that didn't even exist.
It reminds me of that night capital glitch in the stock market back in 2012. They lost, $440 million in 45 minutes from a bad algorithm. How fast did Bithumb catch this one?
They were faster. Thankfully. Within about 35 minutes, they'd restricted 695 accounts. They managed to claw back 99.7% of the assets because, again, it mostly hadn't left the platform.
That 0.3%, though. Someone definitely got away with a life-changing amount of money.
I think that's a safe bet.
But looking at the nifty thought from our newsletter, there's a surprising takeaway here. You'd think this proves centralized exchanges are incredibly dangerous, but the analysis sort of suggests the opposite.
It's a bit of a paradox, right? The glitch itself was a massive failure of process, no question. But the recovery, that was a triumph of solvency. The fact that Bithumb could absorb that chaos, freeze the accounts, and maintain 100% reserves for everybody else proves their internal safeguards actually worked.
So they failed the don't make a $40 billion mistake test, but they passed the survive a $40 billion mistake test.
Precisely. And they're trying to make it right, waiving trading fees, letting users keep some small cash drops. But this whole story pairs really well with a sidebar item from that same day about the CFTC.
Right, the U.S. regulator. They expanded eligible collateral to include stablecoins.
It seems totally unrelated, but think about the contrast. In Korea, you have this Wild West operational meltdown. At the same time, in the U.S., you have the CFTC quietly integrating crypto deeper into the plumbing of traditional finance. They're basically saying, okay, stablecoins are reliable enough to back major trades.
It just shows the market is maturing on two different tracks. The regulators are moving from ban it to integrate it, even while some exchanges are still, occasionally lighting themselves on fire.
Which brings us perfectly to Tuesday, February 10th. If Monday was about the risks of centralization, Tuesday was all about the industry's solution, better incentives, and the rise of decentralized alternatives.
And we have to talk about Backpack Exchange here. They announced a new tokenomics structure that, it just feels like a direct response to that whole predatory VC narrative from the last cycle.
It's a radical shift.
Yeah.
The standard model for the last 5 years has been, VCs get in early, they get cheap tokens, they hype the project, and then they dump on retail investors the second the tokens unlock.
We've seen it happen.
Backpack is slipping that whole script. They're calling it the anti-dump strategy.
For good reason. So they're doing a 25% airdrop to the community when the token launches. But the real kicker is the insiders, the founders, and the VCs. They get 0 liquid tokens up front.
0. That is just unheard of. Usually there's a 1-year cliff, maybe, but then it starts unlocking every month.
Right.
Here, their rewards are tied to equity, and they're locked until 1 full year after a potential IPO.
Wait, hold on. 1 year after an IPO. That could be 5, 7, even 10 years from now. They're locking their money to the actual long-term public success of the company.
It aligns the incentives perfectly.
Mm-hmm.
They do not get paid unless they build a product that's good enough to list on a major stock exchange. They can't just hype a token and walk away. And given the Backpack just hit a reported $1 billion valuation, that's a huge amount of paper wealth they're choosing to lock up.
It forces them to be builders, not just extractors of value. But is the market actually rewarding this kind of approach, or are people still just flocking to the biggest, most established names?
Well, the data suggests there's a real shift happening. We saw a really interesting stat on Tuesday comparing Hyperliquid, which is a fully on-chain decentralized exchange, against Coinbase.
The classic David versus Goliath story.
Except David is getting bigger than Goliath now. The data showed Hyperliquid doing about $2.6 trillion in volume compared to Coinbase's $1.4 trillion.
Wow, that's staggering. So Hyperliquid is running on transparent smart contracts, and it's doing nearly double the volume of the biggest, most compliant U.S. exchange.
It tells us that serious traders are voting with their liquidity. They prefer the transparency and the self-custody of DeFi over the black box of centralized players, especially after you see glitches like the one at Bithumb. The DeFi infrastructure is finally catching up to the user experience of CeFi.
The training wheels are coming off. This transitions us perfectly to Wednesday, February 11th. We move from trading infrastructure to what I think is the most sci-fi concept of the week, agentic finance.
This is a term you are going to be hearing a lot more of in 2026. This all came up because Tether, the company behind the USDT stablecoin, made an investment in LayerZero Labs.
Okay, so on the surface, that seems like a pretty boring infrastructure play. Tether just wants its dollar to move between different blockchains more easily. But you think there's a bigger play here, something to do with AI.
It's all about the why behind the investment. Think about where AI is heading. We're not just going to have chatbots. We're going to have autonomous agent software that books your flights, manages your investments, maybe even orders your groceries for you.
Right. But an AI agent can't exactly walk into a bank and open a checking account. It doesn't have a driver's license or a social security number.
Exactly. The entire legacy banking system is built on human identity, KYC, anti-money laundering. It all requires a human face. AI agents are fundamentally incompatible with that system, but they work perfectly with crypto.
Because crypto is permissionless.
Correct. So by investing in LayerZero, Tether is building the plumbing for the AI economy. They're creating this layer where an AI agent on the Solana blockchain can pay another AI agent on Ethereum for some service instantly using a stablecoin, and a bank never even has to be involved.
That is wild. We are literally building a financial system for non-human actors.
It's really the only way the AI economy can scale. These agents will be doing millions, maybe billions of tiny micropayments a day. Visa, a MasterCard's fee structure, can't handle that. Blockchains can.
And while Tether is busy building for the robots, the traditional banks are still just loading up on the assets. Wednesday also gave us the Goldman Sachs Q4 filing.
The barbell strategy in action. You've got the futuristic AI stuff on one end, and on the other, you have Goldman Sachs revealing they hold $2.36 billion in crypto assets.
Mostly in the ETFs, I assume.
Yep, Bitcoin and Ethereum ETFs. But $2.36 billion is not a toe in the water anymore. That's a real conviction bet. It shows that no matter how volatile things get or how many fat finger errors happen in Korea, the biggest allocators of capital in the world are not leaving. They're digging in.
Okay, just quickly, there was a sidebar on Wednesday about Polymarket partnering with Kaido AI.
Yeah, to launch attention markets.
Yeah.
It actually ties back to this whole AI theme. They're using AI to quantify internet trends and let people bet on them. It's the financialization of attention, which is a whole other rabbit hole, but it just shows how data and finance are merging.
All right, let's move to Thursday, February 12th. If Monday was the chaos, Thursday was the validation. This is the story that I think really changes the next 5 years of this industry. We're calling it the BlackRock pivot.
I don't use the word monumental lightly, but this really fits the bill. BlackRock listed its BUIDL fund on Uniswap.
Okay, so for anyone who doesn't live on Twitter, let's break down why this is so weird. Uniswap is a decentralized exchange. It's permissionless. It's where people trade, meme coins. BlackRock is the most buttoned-up suit-and-tie firm on the planet. Why are they meeting there?
That is the clash of cultures right there. The BUIDL fund is a tokenized U.S. Treasury fund, and it's managing about $2.2 billion. Until now, it lived in this fairly walled-off garden. By listing it on Uniswap, BlackRock is essentially admitting that the future of trading might not be on the NASDAQ or the NYSE. It might be on these liquidity pools that are governed by code.
So they're actually using the rails. They aren't just buying the asset like Bitcoin. They are using the technology, DeFi, to settle their transactions.
And it gets even more interesting. The headline that really shocked everyone was that BlackRock didn't just list the fund. They actually purchased UNI governance tokens.
This is the part that blows my mind. The UNI token lets you vote on changes to the Uniswap protocol. Why on earth does Larry Fink need to vote on Uniswap code upgrades?
It becomes a strategic necessity. If you're going to move billions and eventually trillions of dollars of real-world assets onto a protocol like this, you cannot be a passive observer. You need seat at the table. You have to ensure the protocol evolves in a way that is compliant and secure for your institutional clients.
But is there a risk here? I mean, people love Uniswap because it's decentralized. If BlackRock starts buying up all the voting power, does it just become BlackRock swap?
That is the tension, for sure. It's the corporate takeover DeFi narrative. But on the flip side, it drives immense value to the protocol. The price of UNI surged 20% on the news because the market realized that if BlackRock is here, the regulatory risk just dropped through the floor. They wouldn't touch this if they thought the SEC was going to shut it down next week.
It validates the entire thesis of smart contracts. It's no longer magic internet money. It's now officially financial infrastructure.
And we saw this echoed in a sidebar on Thursday, too. Athena powering in a SUI dollar on the SUI network. It's just more evidence of these yield-bearing stablecoins becoming standard across every blockchain. But BlackRock is the signal that lets everyone else follow.
Which brings us to Friday, February 13th. We've gone from South Korean chaos to AI agents to BlackRock governance, and we end the week buying groceries with a penguin.
It sounds ridiculous, but Friday was all about the pudgy penguins.
The NFT collection, they launched something called the Pengu Card with Visa.
Correct. And before you just dismiss this as a marketing gimmick, you have to look at what it actually does. It lets users spend their digital assets, including stablecoins, at 150 million merchants around the world.
So it's a crypto debit card. We've seen those before from places like Coinbase or Crypto.com. What makes this one different?
It's the branding and the source. Usually these cards come from an exchange. This is coming from an intellectual property brand, an NFT project that is now issuing a financial product. It completely blurs the line between culture and banking.
And it creates a seamless loop, right? If you're earning yield in DeFi or holding value in an NFT, you can now spend that value at the grocery store without doing that whole 7-step process of sending it to an exchange, selling for dollars, wiring to your bank.
Exactly. It removes all the off-ramp friction. It abstracts the crypto part away. For the user, you're just swiping a card, the merchant gets dollars, you spend your crypto. The complexity on the back end is totally hidden.
And the perks were actually pretty competitive. 6 to 12% cash back.
Tiered, of course, standard, premium, and luxe. But yeah, that's better than what you get from a Chase Sapphire or an Amex Platinum. It suggests the economics of crypto-native finance might actually be more efficient, allowing them to pass more value back to the user.
It's another example of crypto products becoming just better products, not just ideological ones.
And Friday had one last little sidebar that fits this theme of better products. Tether Gold introduced something called Scudo.
What's that?
It's basically just a new unit for their on-chain gold to make it easier to transact with. It breaks down gold bars into smaller, more spendable units. So whether it's the Pengu Card or Scudo, the theme for Friday was all utility, making these digital assets liquid and usable in the real world.
So if we look back at the whole week, we started with a $40 billion error that should never have happened, and we ended with BlackRock and Visa getting deeply integrated into the space. How do we synthesize all this?
I think if you look at the noise, it was Bithumb. It was loud, it was scary, it got all the headlines, but it didn't change the structural direction of the market. It was a speed bump.
And the signal?
The signal is integration. For the last decade, crypto has basically been an asset class you speculate on. You buy it, you hold it, you hope it goes up. This week showed us the shift to an asset class you use.
Use for what, though?
Everything. BlackRock using it for settlement, AI agents using it for payments, pudgy penguins using it for consumer credit. We are moving out of the casino phase and into the utility phase.
And the institutions, they aren't waiting for permission slips anymore. They're just building.
They really are. And this leads me to a kind of provocative thought for you to take into the weekend.
Let's hear it.
We used to always ask, when will the banks finally adopt crypto? But after this week, looking at Backpack Exchange aligning incentives better than Wall Street and pudgy penguins offering better cash back than Amex, maybe the real question is, are crypto-native companies becoming better banks faster than banks can figure out crypto?
That is the race to watch. Who owns that customer relationship in 2030? The bank that finally added a Bitcoin tab? Or the Bitcoin wallet that added all the banking services?
I know where I'm placing my bets.
Well, we will leave you with that thought. A huge thank you for tuning in to this deep dive.
And remember, this space moves way too fast to catch up just once a week. For the daily play-by-play, you should really follow our newsletter, Nifty Noon, on X and Substack. That's where we break all this down as it happens.
Thanks for listening, everyone. We'll catch you in the next one.